Okay, good morning, Liba.
Good morning.
Okay, I guess we're ready to get started here, all right?
Yes.
All right, with no further ado, we're into the PowerPoints. And let me just make sure you can see the PowerPoints here. You see the PowerPoints?
Yes, I can.
Okay, here we go. Analyze the effect of business transactions on the basic accounting equation. The accounting equation, assets equal liabilities plus equity. Never forget that. Assets equal liabilities plus equity. And we'll get into that a little bit. Using the accounting equation to analyze transactions, an accounting system collects data, processes it, and most importantly, communicates it to decision makers. Now we're going to go through the arrows here today, okay? Analyze business transactions. Accounting information systems rely on a process referred to as the accounting cycle. The accounting cycle. What's happening, Liba, the month begins and you start recording transactions. We're paying the electric bill. We're paying our employees. We bought some material. We sold some inventory. We're journalizing all these transactions, and then we're going to post to the trial balance, do adjusting journal entries, and then come up with the financial statements and close out. So we're starting the accounting cycle now. Transactions, they're simply economic events that require recording in the financial statements. Not all activities require transactions. Assets, liabilities, or stockholders' equity items change as a result of an economic event and has what's called a dual effect on the accounting equation. When it says not all activities require transactions, you hire somebody. You announce that you hired a new vice president. That's not a transaction. That's just a bit of information. Okay. Identify, are the following events recorded in the accounting records? Purchased a computer. Absolutely yes. Discussed a trip with potential customers. No, that's just a sales pitch, which we hope will result in a transaction. You pay the rent. Yes. So certain things you record, certain things you do not. So take a look at the accounting equation, everybody. There it is. Assets equal liabilities plus equity. Assets equals liabilities plus equity. And it must always be in balance, and every event has a dual effect on it. If an asset is increased, that means another asset went down, or a liability went up, or equity went up. Let's look at the elongated accounting equation here, okay? The accounting equation is assets equal liabilities plus equity. Stop. That's the accounting equation. But let's look at the stockholders' equity section now. That consists of various things like common stock, if the company issues stock to the public, retained earnings, if they add any income over the years, and you have revenues, expenses, and dividends. Revenues are sales of your product. Expenses are just that. Expenses like rent, cost of goods sold. You may have paid some dividends. Revenues minus expenses equals net income, and that gets moved up to the stockholders' equity section via retained earnings. Any dividends paid by the company, same thing, goes up to retained earnings. So your equation is still assets equals liabilities plus stockholders' equity. But at month end, all the movement is going to go into stockholders' equity. Another way that I might say it is during the month, you're not making any entries that affect stockholders' equity, really, for the most part. It's only at the month end when you close out that all this action occurs. So we're going to go through some transactions here. And Libby, you slow me down if you think I'm going too fast or I'm talking too quickly in my New Jersey accent here. So let's see what happens. Note what they've done here. They've laid out the accounting equation for us. Assets equal liabilities plus your common stock plus equities. Assets equal liabilities plus stockholders' equity. Cash of 10,000 is invested in Sierra Corporation by investors. So these people went out and they issued stock to the world. Look at our accounting equation. Cash went up, and so did common stock. Okay, we're still in balance. $10,000 equals 10,000. On October 1st, Sierra borrowed 5,000 from Castle Bank by signing a 3-year note payable. So what's going to happen here? They borrowed money. They borrowed cash. So cash is going to go up, and so is the liability called notes payable. And there we go. Sierra received a $1,200 advance from Arnox, a client. So we know cash went up. What's the other half? The other half is going to be called something called unearned service revenue, which you've not seen yet. When you receive money in advance from a customer prior to doing anything, you cannot call that income. You have to call that a liability called unearned service revenue. You owe this person the service, not money, but the service. And Sierra received 10,000 in cash from Copa Company for guide services performed. So now we have our first revenue, $10,000. And notice revenue went up. And notice we're always in balance here. Sierra Corporation paid its office rent. Well, that's an easy one. They're finally spending some money, huh? This company's been a cash cow so far. So cash is going to go down and an expense is going to go up. And there we go. So far, so good, Liba?
Yes.
Okay. Sierra paid $600 for an insurance policy that expires next September. So they're paying in advance for this insurance policy. This insurance policy is not an expense at this point. It is an asset to be used in the future. So looks like cash is going to go down by 600 and prepaid insurance will go up. Prepaid insurance goes up. On October 5th, Sierra purchased an estimated 3 months of supplies. This is the same thing. This is going to be prepaid supplies, or as they call it, supplies. Cash goes down. Oh, it's on account. You see where it says the words on account, Liba? Whenever you see those two words, on account, it means on account of nobody had money. It means on account that no cash was involved. So when you see on account, it's going to be either accounts payable or accounts receivable, okay? So here we're purchasing something, so accounts payable is going to go up by $2,500, and the prepaid supplies go up by 25. Here, they hired 4 new employees to begin work on the 15th. Oh, excuse me. Sierra hired 4 new employees to begin work on October 15th. Is that a transaction? The answer is no. All they did was hire somebody. So there should be no transaction there. And they're not showing anything. So that's right. On October 20, Sierra paid a $500 dividend. Well, cash is going to go down and dividends will go up. The dividend is a payment to a stockholder for holding the stock. Companies don't have to pay them. Some regularly do, some never pay a dividend. And it affects the dividends and cash. Employees have worked 2 weeks, earning $4,000 in salaries, which were paid on October 26th. So here we're going to have salaries expense. And it looks like for some reason they skipped that one. You notice that? They stopped at 500. Number 11, you would have seen a $4,000 reduction in cash and then a $4,000 increase in expense. So there's a mistake in the textbook. And here we go. Let's take a look at it. Assets equals liability. Describe each transaction. A tabular analysis of transactions for the month is shown. Describe each transaction. And what they want you to do, and we'll do this briefly here, Liba. is they want you to say, look at transaction number 1. What happened? Well, you read it, you can see they issued common stock. Number 2, what happened? They bought equipment. Number 3, they got cash from selling their product to somebody. They paid the rent. And what they're showing you is that the accounting equation remains in balance at all times. $39,000 equals 7,000 plus the 25 plus the 8 minus the 850. All the components of stockholders' equity. Come on, come on. Doesn't want to move. So that was a quick review of the stockholders' equity. Now we're going to get into the real guts of it. This is where it's going to get tricky for a little bit, Liba, until you and everybody get familiar with debits and credits. Debits and credits. Debits and credits. Every journal entry, let me say it this way, every transaction affects 2 or more accounts. By definition, you have to have at least 1 debit and 1 credit. You can have 1 debit and 100 credits. You can have 1 credit and 100 debits, but you must have 1 of each at a minimum to record a transaction. Excuse me. If debits are greater than credits, the account will have a debit balance. And what we're looking at here is called a T account, and we'll get into that shortly. You could have, let's pretend this is cash. You have account name cash. The debit side is on the left, credits on the right. They had $10,000 in the first transaction. They received money. They received another 18, and offsetting that is 3 that they spent. So the balance is a debit balance of $15,000, okay? Debit and credit. The only thing debit means is left, credit means right. That's all it means. Debit means left, credit means right. A debit is not better than a credit is not better than a debit. There are no value judgments here. Just means left and right, according to the rules of accounting. If credits are greater, it would have a credit balance. And notice we'll say we had 0 beginning balance. Then we had plus 10, and then we have minus 3, minus 8. That might have been prepaid revenue or something. Asset accounts, debits should equal credit, should exceed credits. Liability accounts, credit exceed debits. Yeah, we should know that, right? Stockholders' equity. You have the different types of accounts. Now, let me see if I can find something. Okay, we'll back the truck up a little bit. Notice that assets increase with the debit. Assets increase with the debit. Therefore, liabilities would have to decrease with the debit. So assets go up with the debit, liabilities go up with a credit, and so does stockholders' equity. Overall goes up with a credit. Common stock goes up with a credit. Retained earnings with a credit. Dividends go up with a debit. And then you have revenues go up with a credit. Expenses go up with a debit. There's no other way I can teach this, Liba, except you just have to memorize them. Assets, debit, go up with a debit. Liabilities, equity, go up with a credit. Revenues go up with a credit. Expenses go up with a debit. Okay. Do you like mnemonics, Liba? Do you like little hints?
Yes, they're very helpful.
Why don't you write this down, okay? After eating dinner, and then put a slash, let's read comics. Okay?
Okay.
After means assets. Eating means expenses. Dinner means dividends. L on the other side of the slash means liabilities. R means revenue. And C means capital or equity. Okay? So you think that might help, Liba?
Yes, hopefully I remember it.
Assets, yeah. After eating dinner, let's read comics. That came from Professor Reyes. There's a million of them. That's the one I think is most memorable. Okay. Oh, the Chicago Cubs baseball team had these major revenue and expense accounts. I'm a big baseball fan, the Chicago Cubs. They finally won a World Series in 2016 after 108 years of misery. Okay, they have three major revenue and expense accounts. They have admissions, that's where they make money, concessions, where they're selling beer, and then they have the TV, radio money, and advertising. And the TV money and advertising, those are their revenues. Expenses, they got to pay the players. They got to pay the people who work in the offices. There's a lot of travel involved, and you got to keep the baseball field in order. Beautiful old Wrigley Field. Let's look at the relationship of the financial statements, if we may, okay? You have a balance sheet, an income statement, and a retained earnings statement. You must do the income statement first. So let's look at that. Income statement. You have revenue minus expenses equals a net loss. We are now going to, that's your income statement. That's as simple as it can get. Revenues minus expenses equals net income. Once we have that done, we're able to go to our second financial statement, which is the retained earnings statement. And we're going to take the beginning retained earnings. We're going to add that net income, and we're going to subtract the dividends. And that's going to give us our ending retained earnings, which we then bring up to the balance sheet. And the balance sheet is assets equal liabilities plus equity. And we're going to go through this in some detail, okay? Here is a good slide library right here, everybody. These are the 5 things you got to memorize. There's no other way to say it. You just have to have them memorized in your head. You have to know that debits have a normal asset, a normal debit balance, etc. When we say an account has a normal balance, what we mean is it normally has a debit balance. We would expect the balance to be a debit. Excuse me. For example, cash. Cash is an asset, so it should have a debit balance. It should never have a credit balance because then you've got negative cash, and you simply cannot have that. If you do see you have negative cash, you've got something wrong. There's something that has not been entered into your books yet, or something was entered incorrectly, or in the worst case, somebody stole something. So we just have to know these rules. Here's another good chart that might help you guys understand the debits and credits again. Assets up with the debit, expenses up with the debit. Okay, they're not showing dividends, but dividends go up with the debit, and you have liabilities, equity, revenue. It's just 6 things to remember. On your test, a lot of the questions are going to be along these lines here. And then another look at the world of debit and credit. So they're giving you all these helpers to try to learn them, okay? Summary of the rules. Debits. Increase assets and decrease liabilities. That's a typical test question around this chapter here. Accounts that normally have debit balances. Look at the mnemonic that I just had you guys write down. Assets after eating dinner. After eating dinner. That would be B. Equity. I'm sorry. Assets. Oh, I'm sorry. I didn't see that on the bottom there. Assets equal after eating dinner. I fouled up my own acronym. Assets, dividends, and expenses, okay? Now, we just learned a little bit about the rules of debits and credits, and the only way you're going to get that memorized is by doing the homework and the assignments, okay? Indicate how a journal is used. We are going to use what's called a journal entry to record the activity into our financial statements, okay? So now we're up to the next arrow here. We're up to the blue arrow. Analyze each transaction in terms of the effect on the accounts, enter the transaction in a journal, and transfer the journal information to the appropriate accounts. So we analyze the transaction in the first arrow. Now we're going to journalize. we are going to write it. I don't like the way they're presenting this, but we're going to have a journal entry, and there's your general ledger. And I'm going to skip this because that's terribly unclear. The general journal, that's what we're calling our journal entries. These are transactions recorded in chronological order before they're transferred to the accounts, to the general ledger. Journal entries contribute to the recording process because it discloses the complete effect of a transaction, provides a chronological record, and it helps to find mistakes and losses. The process journalizing. What is journal entries? What are journal entries? Journalizing is the process of entering transaction data in the journal. So let's look at a transaction here. Sierra issued common stock for $10,000. It borrowed $5,000, and then it bought equipment for $5,000. Let's write the journal entries. Here we go. Now here's a very clear look. What we're doing here, guys, is we're going to go through the same transactions we just did earlier, only this time we're going to do them via journal entries. So let's see what we have here. Sierra issued common stock. Cash goes up with a debit. Common stock goes up with a credit. Look at your journal entry, your general journal. It's going to have a date. The year you only have to put one time on the top. You don't repeat the year all the time. So you just put the year up there on top one time. The date, the debits go first whenever possible. Debits go first. Credits are always indented. You notice the indentation there? Credits are always moved over a little bit. You debit cash 10,000, you credit common stock 10,000. All right. Your first journal entry. Remember where you were when you saw it. Here, they borrowed $5,000. So what went up? Cash went up, and so did notes payable. They both went up. Okay? Except cash went up with a debit. Notes payable went up with a credit. All right. They bought equipment for cash. Equipment went up for 5,000 by 5, cash went down by 5. And they're summarizing the journal entries. That's what you'd be looking at in your system. You go into your computer system, is what you'd see. Okay. Notice they gave an explanation for each journal entry. Issued stock for cash, issued 3 months, 12% note. Those are actually very, very important for a lot of reasons. Reason number one, you're not going to remember a journal entry you wrote 6 months before, probably, but when you have a little note there, it tells you why you wrote it. Okay. And also, if you can't write a very simple 3 or 4 word explanation for the transactions, it could be wrong. And that's why those explanations are useful. Looks like we have more journal entries to do, huh? Issued common stock to shareholders. There we go. Issued common stock in exchange for cash. We debit cash, we credit common stock. We purchased 4,800 of equipment on account. On account means it's going to be accounts payable or accounts receivable. And what are we doing here? We're purchasing something so that would clearly be accounts payable. And then we interviewed 3 people for the position of a stylist. Explain how a ledger and posting help in the recording process, huh? Now, notice we're up to the blue arrow, the 3rd arrow. And today we're going as far as, I think we're just going through the trial balance. I'm not sure. But we go post to the ledger accounts. We have now entered journal entries, okay? All we've done so far is go into our accounting system, if it's QuickBooks or Oracle, whatever, and we did debit cash, credit revenue, debit and expense, credit accounts payable. But just writing the journal entry doesn't do anything for you, okay? What you have to do now is tell your computer system to post it to the general ledger, posting to the ledger. Need my coffee. So let's see what this is all about. The ledger, your general ledger, is comprised of the entire group of accounts maintained. Think of the general ledger as a bunch of folders. You have assets, you have cash, supplies, land, equipment. Those are your assets, liabilities, the payables, stockholders' equity. Your general ledger is going to have one folder for each account. You're going to have one called cash, and it's going to have the debit side and the credit side. It's going to show the balance. And here they're showing you something called the chart of accounts. This company decided these are the areas of the business they want to track via the general ledger: cash, receivables, supplies, etc. Okay. Okay, posting. Let's take a peek here. We wrote the journal entry. We debited cash for common stock, but it wasn't until we clicked on that arrow. Once we hit the button that said post, whammo, it posts to the general ledger. These T accounts you see here are your general ledger. It's the poor man's general ledger for illustrative purposes. We debit cash and we credit common stock. Once you've done that, you've entered a permanent record to your general ledger. It can never be reversed. It can never be removed. It can never be reversed. If it's wrong, all you can do is write the correcting set of entries to change it. Posting normally occurs before journalizing. No, it doesn't transfer ledger. If there's a God in heaven, the answer is D, right? It transfers journal entries to the general ledger. The general ledger, those are the books of the company. You've heard that expression, the company's books. I want to see the books. The books are cooked. Recording process illustrated. Steps in the recording process: determine what type of account is involved, what goes up and down, and translate into debits and credits. So here, and these I'm going to go through a little more rapidly because this is the third time they're showing these same transactions, okay? This is the third time. But let's take a peek at it. They invested $10,000 in a company, okay? They invested $10,000. Or rather, they had investors give them $10,000. They issued stock to the public. So what happens? Look at the journal entry. We debit cash, we credit common stock, and then our simple explanation to record stock issue, 10,000. So that's pretty easy, right? The journal entry. Now we hit the button called post, and now it updates our general ledger. When the auditor comes in at the end of the year to do her work, she's going to come up to you and say, show me your general ledger for cash. And she'll say, how much cash you guys have? And you say you have $10,000. She'll say, okay, prove it to me. Show me your bank statement. Then you show the bank statement. Then she's going to mark things on the bank statement and verify them with the bank. The point is, the auditors will always start inward with the general ledger and work their way out, okay? Here's our second one, where we borrowed $5,000. Cash, notes payable. Cash now is up to $15,000, right? We have a $10,000 and a $5,000. They spent $5,000 to purchase equipment. So equipment is an asset. Asset went up. Cash is an asset. An asset went down. Just exchanged assets. They received an advance. This is that liability I was talking about called unearned revenue. Notice the cash amount is building up now. They received here they sold their product or their service for revenues. Cash went up 10,000, revenues went up 10,000. They paid for office rent, huh? So what do we debit? We debit rent expense to increase the expense, and we credit cash to reduce the cash amount. Sierra paid $600 for a one-year insurance policy that expires next September. So at this point, this is a prepaid item. We're going to debit prepaid insurance, credit cash. And again, we debit we hit the posting button, we debit prepaid insurance, we credit the cash. here we go. They bought $3,000 or $2,500 worth of supplies, 3-month supplies. These are prepaid supplies. We debit, we credit payables. On October 9th, they hired 4 employees to begin work. Each employee will receive a weekly salary of $500. This is not a transaction. This is just a press release, okay? Nothing here. Nothing to see here, ladies and gentlemen. Let's keep walking. They paid $500 dividend. Ooh, if you own stock, you got $500 now, huh? Whoever owns the stock. So what gets debited? Dividends get debited after eating dinner, and cash is credited $500. Keeping in mind that dividends are a part of stockholders' equity. Stockholders' equity consists of the common stock, it consists of the dividends, and the revenues and expenses affected as well. They paid their employees. Well, that's an expense, huh? Debit salaries and wage expense, credit cash. And here they're showing you the journal entries, what the journal entries look like. And that's what a journal entry is. It has a date, a column here for the debits and credits, and then the numbers out here. Showing you a little more. They're just repeating what we just did. So here's what would have happened. You would have gone into your system and you would have entered all these transactions. Now you're looking at the screen and you're double checking. Okay, that looks right. That's right. This is good. Oh, I got to fix that. And then when you've done your due diligence, now you post it to the general ledger by hitting the post button. Take a look at your general ledger here. This is, again, a simple look at the general ledger. This is at the end of the month now. You have cash. You started off with 0. You brought in 10,000 in cash, 5,000. You end up with a balance of 15,200. You got that number by adding the debits and subtracting the credits, and the high man wins. Hopefully we never had a credit balance in cash. Supplies, okay, that looks good. Look at common stock, that has a credit balance. So we're looking pretty good here. That is our general ledger. And from that, we'll be able to start doing some financial statements. Okay, posting. Now they're going to do what I've been talking about. You post. Selected transaction during its first month of the operation are presented below. So they're just showing you some random transactions. And they say post. Hit the magic button, post. You hit post and they end up going into these different accounts, okay? I don't know why they don't finish it and show you the numbers. Objective 5, trial balance. Trial balance. At the end of the month, we are going to prepare what's called a trial balance. Trial balance, very important. Whoops. A trial balance is a list of all the accounts in account number order. They're by definition in the order of assets, liabilities, equity, revenues, and expenses. And we're going to list, if it's a debit balance, we put the balance in the debit side, otherwise it goes in the credit side. And the only thing the trial balance does for us is prove that the debits equal credits. That's all it does. And it's a very useful item to find mistakes. But its most important use is in the preparation of financial statements. So let's take a breath here and understand that the trial balance is a list of everything in your general ledger. I see 15, you see 15,200 in cash, 15,200 in cash. Remember the 15,200? There it is right there. Here is all the activity for the month in cash. At the end of the month, we had 2,500, 15,200. We had 2,500, 600, and 5,000, 2,500, etc. That's where these balances came from the trial balance. All right, trial balance. The trial balance, now here's a problem with a trial balance. A trial balance may balance even if everything's wrong. Even, you know, even if, even when a transaction is not journalized, the correct journal entry is not posted. You could have posted something twice. You could have reversed some numbers. So a trial balance, again, is only as good as the numbers that were put into it. A trial balance is simply to prove that debits equal credits. Now, in the year 2022, no accounting system is going to allow you to go out of balance. I don't think there are too many pencil accounting departments like there used to be in my age many years ago. And here, prepare a trial balance from this information here. Well, we decided that we start with assets, right? And the assets and liabilities are always in the same order of what's called liquidity, meaning the ease of which you can turn an asset into cash. I'm getting way ahead of us with that, but let's just take a peek. They want us to prepare a trial balance. Well, we know cash is going to go first. Accounts receivable typically goes second. Then let's see what else. Accounts receivable. I see prepaid insurance, and then I see equipment, and I think that's everything. So we're looking at cash, receivables, prepaid insurance, and equipment. Cash, receivables, prepaid insurance, and equipment. Notes payable, accounts payable. Notes payable, accounts payable, 19 and 22. There we go. You get the idea? Service, we got, okay, we got salaries payable. Where's salary? There you go, 2,000. Then we got the common stock. Do we have retained earnings? I don't see retained earnings. I see dividends. And then we have our revenues and expenses. So if this trial balance was absolutely perfect, let's pretend that this trial balance is perfect. There are no mistakes. We can then prepare the financial statements right from the trial balance. That's what the final trial balance is going to do for us, okay? And again, I'm not getting into the world of international. There are some differences between GAAP and the international financial systems, which I don't cover here, and nor do any of the other teachers, I believe. So with that in mind, we are done with our chapter. We are done with today's lecture. Any comments, Liba?
Yes.
Question?
Do we need to know the equations for the exam?
The equation?
Any equations?
Repeat the question. I didn't quite hear it.
Do we need to know the equations for the exam?
Absolutely.
Okay.
Yeah. You got to know that equation like the back of your hand. Yeah.
Mm-hmm.
You got to know what side debits and credits are on. Yeah. You keeping up with the homework and everything, Liba?
Yes.
All right.
I already did the readings for chapter 3, so
Okay.
trying
So
to
you
stay
should.
ahead.
Okay. That's excellent. That's the way to do it. Yeah. If you're doing things the way we recommend, you read the chapter, you go through the reading a chapter prior to our meeting here. Okay. Well, I guess our next session will be Thursday, right?
Yes.
Okay. So we'll see you on Thursday. Okay, Liba?
Okay. Bye.
Bye-bye now.